The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. My name is Jason Collins, and I'm with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have many options as to where to place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. Welcome. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers MedSup and MedAdvantage products. Please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist with your success. Again, that website is www.urlinsgroup.com. I'm excited to be part of presenting this great program for you today. Single premium life has been growing in popularity the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no interest in CDs or savings accounts, or have real concerns about their future in regards to long-term care should they need it. Today we're going to discuss a product that will help your clients with these concerns. I'm proud to introduce Jon Thomas with Nationwide Insurance. Jon is Nationwide's virtual wholesaler for long-term care sales. He is here to review Nationwide's CareMatters single premium life product and how it will discuss how it will benefit your clients. Now, before I turn it over to Jon, I'd like to mention, should you have any questions during the broadcast, there's a question box on the right side of your screen that you can type the questions in, and we'll answer it at the end of the program. So without further ado, I'd like to turn the program over to Jon.
Thank you, Jason. Really appreciate the introduction, and really excited to present with you all this morning. Jason mentioned who I am. I am a virtual wholesaler with Nationwide, which really just means that I focus on promoting our linked benefit product and long-term care solutions. And I do a lot of webinars and things like this. So that is really my expertise, and I'm happy to share with you a little bit about what we offer and a new product we have in the marketplace. As I'm switching my screen over here, I do want to share with you a little bit about the background of Nationwide and who we are and where we're coming from. So you may not know that Nationwide has been in the long-term care space for some time. We have actually been in the long-term care space for about 16 years. We introduced a long-term care rider in 1998. That was our initial foray into the market. And we've developed a product in 2013 called CareMatters. That was our linked benefit solution. It was a slow introduction into the market, and over the last 2 years we've expanded and developed this product, and excited to share a little bit about it with you here now. Jason, can you see my screen? Am I showing all right? Bear with me just one moment. I want to make sure I've got this screen set up for us here. Okay. I believe I'm all set. Jason, please let me know if you can't see my screen. Okay, but a little bit of an agenda. The importance of having LTC coverage. I do want to talk about that a bit, and what CareMatters is, how it works, and really why it's different in the marketplace and what opportunities there are for your business. Talk a little bit about indemnity versus reimbursement, which is Nationwide's value statement, and really what our purpose and value is when it comes to long-term care insurance. That word cash indemnity, I want you to look for during the presentation, really take hold of and log that away as Nationwide's value in the long-term care insurance space is cash indemnity. And then go through some examples and some different sales ideas and positioning statements that will really help illuminate clients that you may have that this would be a good solution for. But first off, and many of you that have been in the long-term care space for any time have probably seen this statistic. 70% of folks living beyond the age of 65 will need some sort of long-term care. Now, that does not necessarily mean that they will use long-term care insurance, right? A lot of this happens informally. Actually, a majority of long-term care currently, or elder care, is provided by family members or provided informally. And a lot of that has to do with our society and our culture and that we care for our family members, but also that long-term care insurance and financial planning doesn't focus on the elder care scenario, right? We focus on retirement planning. We focus on that first phase of retirement, which is really the accumulating and then distribution of assets to provide this retirement lifestyle. But that second phase of retirement we don't often think about, which is once we become frail, we need a little bit of help, and we may need to pay for some sort of care. And we don't often plan or financially plan for that next phase or aspect of our lives. We don't, identify with risk pools. So Nationwide, you've probably heard our jingle, Nationwide's on your side. You've seen a commercial or two. You know that we have a strong auto and property and casualty brand. And from that property and casualty brand, our experience is that people don't identify with risk pools, right? If you say, and with this statistic, 70% of folks living beyond 65 will need some sort of long-term care, the majority of people will say, well, shoot, I'm going to be that 30%, right? Maybe I work out once or twice a year and I feel like I'm healthier than everybody else, so I'm not going to need it. Well, when it comes to homeowners insurance, for example, you have an asset in your home that you cannot afford not to cover, right? Very, very few people actually use homeowners insurance. Very few people have a fire or a flood in their home that causes them to utilize their homeowners insurance. But if it did happen, the cost is so catastrophic you couldn't afford not to be covered. That statement is also true for long-term care planning. For those people that have, especially a more catastrophic issue like Alzheimer's, like dementia, you can't afford not to plan for it, right? Because the result is devastating to family members and to that individual. Now, there are a couple of ways that we do plan for long-term care, and this is done informally. We may not talk to a financial planner about it, but lifestyle really is caring for our loved ones, our family members. So many people plan to care for one another through their lifestyle, right? And there are others that say, well, if it comes to it, I'll just pay for it out of my income, right? So I have sufficient retirement income that will pay for my lifestyle plus any sort of care costs. And that final is insurance. We can leverage insurance to create a benefit for us to cover our long-term care. There is a cost to unpaid caregiving. And I want to highlight this as it is important because it went into the design of Nationwide's product, and it helped influence our product design. And it's the second bullet point you see at the bottom of the slide here. The average unpaid caregiver is a middle-aged woman who works or did work full-time, but loses an average of $565,000, almost $500,000 in lost wages and benefits over her lifetime. This is most commonly an adult child, maybe the eldest daughter, that provides care for her parents when they need it. Maybe she has to quit her job to move back home with her parents. Maybe she has to move out of state back home, or just reduce hours at her job so that she can help provide care. Many of us have experienced this in our own families, and this is a problem when it comes to financial planning, because not only does it affect that daughter, but it many times causes a lot of trauma and issues with the family, right? Relationships really do suffer because of this. Now, when we talk about financial planning and using income to pay for long-term care, what people don't often realize, what clients don't realize, is that income comes from assets, right? And those assets that are creating the income often aren't enough to create enough income to maintain their lifestyle, but also to create an inheritance, right? Now, we want to create income, we want to create an inheritance, but we also, if we have a long-term care need and we have to pay for care, one of those things are going to suffer, right? The income that's creating our lifestyle or the inheritance. If we've not planned sufficiently to pay for long-term care, one of those things will suffer. So many people would love to be able to create income and leave an inheritance and cover their long-term care costs. And this is where that conversation starts. Now, in the insurance world, we have a couple of ways to prepare. We have traditional long-term care insurance. Many of you, I'm sure, are familiar with traditional long-term care. Historically has been called nursing home insurance. And that does provide some challenges because many people would say, I don't want to go to a nursing home. Why the heck would I buy nursing home insurance, right? When it originated, it was originally called nursing home insurance, but that has changed. It's become a lot more flexible, but unfortunately the stigma has somewhat stuck with traditional long-term care insurance, right? And beyond that, many of you, especially if you've written some traditional long-term care insurance in the past, have seen that premiums have increased substantially over the last few decades. So someone that's had an insurance policy for 15, 20 years may have seen their premiums go up 40, 50, even 60%. And so that has put a sour taste in many people's mind when it comes to traditional long-term care insurance. About a decade ago, long-term care insurance, long-term care riders on life insurance was introduced. A long-term care rider is essentially a rider that you can add to any permanent life insurance contract that allows you to accelerate that death benefit prior to death and use it for long-term care expenses. So nationwide, when we originally introduced long-term care at our company in '98, that was a rider on our life insurance product. It is a little less customizable, less flexible than traditional long-term care, and it really is intended as a life insurance solution if you make that sort of sale. It's a life insurance solution, but for a nominal cost, you could throw on a rider that allows you to use that death benefit early. That third column you see there, linked benefit policy, that is the CareMatters contract I'm going to talk to you a little bit about today. But that is really a mix of the two. It's the best of both worlds. It has the guarantees that are built into life insurance, but it is also more customizable, more flexible like traditional long-term care insurance. And so it, in many ways, for many people, is the best of both worlds. This product, it is sometimes called asset repositioning vehicles or an asset-based investment. They are commonly single pay only products, but many times you can pay them over 5 or 10 years as well. Nationwide's product does offer a single or a 5-year or a 10-year payment option. And I'm going to, on this next slide here, give you an infographic that really explains how the product works. And we're going to take a 55-year-old female. Let's say maybe she worked for state government, she got an early retirement, has a large pension that she is supporting her income, and she got a big bonus at retirement, so she has some liquid assets. Maybe she was bonused $200,000 to $300,000 for accrued time after she left her employment. She wants to plan for her long-term care need, and we're going to take some of that liquid asset that she has and reposition as a alternative investment to plan for her long-term care need. We're going to take $100,000 and place it inside this CareMatters policy, and it will do two things. The first thing it will do is create an immediate death benefit. So this is the death benefit that's guaranteed regardless of what happens. If she were to pass away, within a year, within 2 years, she's leveraged at $100,000 for $180,000 of death benefit. But the bigger benefit is the long-term care. And you'll see in this final column, this big blue column, there's a total of $541,250 in LTC benefits. And that's paid out over 6 years in this example at $7,517 a month. So we have an initial death benefit pool, then we also have total LTC benefit that's much greater. And the product really is designed to provide the total LTC. But one of the challenges with traditional long-term care is this perception that if you don't use it, you lose your investment, that you don't get anything for the premium you've paid. So this product really does answer that question of, well, what if I die and never need long-term care? Well, you do have leverage for death benefit. So that is crucial. We also provide in this CareMatters product a residual death benefit of 20%. You see it in this gold box below at $36,083. That residual death benefit is paid no matter what. It is a guaranteed minimum. So if we burn through our entire $180,000, this first initial benefit pool, and we continue on receiving more long-term care benefits and then pass away, Nationwide guarantees will pay at least this $36,000 in this example, or 20% of the original specified amount. So that is really what I like to think of as a final expense policy that's attached to the contract. And this became important as we were designing this product. We talked to a lot of different consumers and a lot of folks that have gone through the claims process with long-term care insurance. And what we found is for people that have a substantially expensive long-term care need, maybe they have Alzheimer's or dementia, and they were in a nursing home for 7, 10 years, they're going to use higher long-term care insurance benefit. And beyond that, they'll probably use up a lot of their personal assets. You know, those more catastrophic situations become very costly. And so they've used up a lot of their personal assets. Well, when that person dies, their family, you know, may have a debt. Their family may have, you know, no assets left. And so this is really a final expense or burial policy that's attached to this. And that really becomes beneficial for those folks that have that catastrophic type need. Now, not only do we provide the death benefit and long-term care benefit, we have a return of premium feature. So it's a 5-year vested return of premium feature that says after 5 years you cancel your contract, you get 100% of premium back. Now the vested schedule begins year 1 at 85%. You cancel the contract year 1, you get 85% of the money back. That increases by 3% each year, so that after the five years you'd get the full return of premium. Now I mentioned that I wanted you to keep in mind cash indemnity. This is the only cash indemnity linked benefit contract available in the market. Cash indemnity is contrast to reimbursement policies. There are several carriers that have linked benefit products. They all are reimbursement contracts. And that difference really comes to, or that difference really plays out in a claim. So in a claim scenario, you either get a monthly check as cash or reimbursed for your costs, right? And so as you're filing a claim, you'll either have to submit bills and receipts to prove and show how much you've spent, and then you get reimbursed for that amount, or as Nationwide pays, you'll get a monthly check. There are a couple other flagship features here I'm going to point out. This fourth bullet point, informal caregivers. Because it is a cash benefit, Nationwide will pay the full benefit really as income for your long-term care need. And we pay it without restriction, and so that allows you to use that money to pay family members. As I showed in that first slide, you could pay maybe your daughter that is providing a lot of the care and had to cut back on hours at work and maybe suffering financially. So this does provide an opportunity to pay informal caregivers, even family and friends, including a spouse. There's no restriction on how you use this income for LTC. I mentioned that 5-year vesting schedule. Here it is laid out on the screen for you, 85% year 1, increasing by 3% each year. I did also mention we offer a 5- and a 10-year payment option. Those work a little bit differently. They're not vested. There is a surrender charge applied if you canceled it within the payment period, but there is a full return of premium the year following your final payment. So with a 5-pay, day 1 of year 6, you cancel the contract, you get everything back. Same with the 10-pay. Day 1 of year 11, you cancel it back, you get all of your premiums back. One of the unique opportunities with cash indemnity versus the reimbursement contracts that are available in the market today, it does pay the owner of the policy. And what's unique about that is it allows you to establish this policy within an irrevocable life insurance trust or an ILIT. So that is unique to indemnity type policies. For our wealthy individuals that have maybe an estate tax burden and want to plan for LTC, they can use this in a more tax efficient manner. We do pay beyond the HIPAA cap. So if you're familiar with the HIPAA stipulation, there is a HIPAA per diem tax exclusion available for those that receive a benefit from a long-term care insurance policy. It allows in 2016 for someone to receive up to $10,200 on a monthly basis, tax-free, without any concern of paying income taxes on what they receive out of an insurance contract. And so we will pay above the HIPAA cap. If a client were to receive something above that HIPAA cap in the current year, whatever they receive above is potentially taxable. Now I say potentially because if they do have, let's say, a concierge level long-term care and they have costs that exceed that HIPAA per diem amount, then it is still tax-free. The tax consideration comes into play if you receive above the HIPAA per diem and you don't have costs above that HIPAA per diem, but you're really taking that excess as income, then that excess could be taxable. I want to walk through a scenario, and this is really where I want to highlight some opportunity that exists for you. And I'm really contrasting our cash product versus some of the long-term care insurance policies that exist, and maybe what your clients have seen before, maybe what has been positioned to them before as a planning tool. And I'm going to walk through a couple of statistics first. The first, that the average cost of home health care in 2013 is about $1,274 monthly. That statistic is a few years old. I think it's more accurate to say nationally the average cost of home health care is about $3,000. And so we're going to use this $3,000 figure and walk through a claim scenario. Over the last several decades, the average claim is just under 4 years. And so you see in this claim scenario, I'm going to use a 4-year claim because that is statistically average and has been for the last few decades. So we'll assume a $3,000 monthly home health care cost, an insurance contract that's going to pay over 4 years. And we'll compare the reimbursement contracts versus Nationwide's indemnity contract. Now, you can imagine as I'm talking here that the indemnity type policy must be more expensive, right? Absolutely. From an actuary standpoint, we guarantee a monthly benefit. We're guaranteeing you income to use towards your LTC expenses. And so because we're guaranteeing a specific amount of income, it is more expensive and more expensive type of policy to insure versus a reimbursement contract that's only going to pay out what the expenses are, and they know from averages what the average costs are and what they're going to pay out versus what their policy actually states. And so this example really highlights that. We have a reimbursement contract that offers us $6,000 a month in LTC benefit, and an indemnity CareMatters contract that offers us $5,000 a month. Well, over this 4-year claim that costs $3,000 a month, the reimbursement contract pays us $3,000 a month. That's great. They cover our costs. They've met the need. Over 48 months or 4 years, they paid us $144,000. Well, the indemnity contract offered us $5,000 a month, and we're going to pay that regardless of the cost. And so over 48 months, and actually we did take off 3 months. Nationwide does have a 90-day, and it's a calendar day elimination period. So once you file a claim, we wait 90 days or 3 months and then kick in those cash payments. So we take 3 months off up front, and over those 45 months we pay out $225,000. Now that was a real easy scenario. It was simple. $3,000 was a pretty easy number to work with, but we know that claims and care costs aren't that simple, right? It's not a flat $3,000 a month for 4 years. It never works that easy, right? Claims are progressive, and care needs are progressive. So, you know, it normally goes a little something like this. A client that is healthy, can do things on their own, eventually gets to the point, and most of us that live long enough, and we all want to live long enough, to get to the point that we will become frail, right? At some point, we're going to get more frail and need some help. And that help often looks like just a little bit of help getting out of bed in the morning, help, bathing, getting dressed, and then maybe that person can do everything else for themselves. Or maybe they have family members to help with meals and cleaning around the house. But it's really help necessary up front. And then as time progresses, that care need and that person's condition progresses, right? To the point where after maybe 5, 6, 7, 8 years, they do need custodial, round-the-clock care. So that's how that care really progresses. And so what we believe is in a progressive type situation like that, when your costs are low to begin with and they increase over time, an indemnity contract is going to give you all of your benefit up front, right? And so you're not leaving money inside of a reimbursement type contract to build up that you'll never gain access to. And an indemnity contract has the biggest potential to give you the most benefit. So I'm going to take this example a step further and show you how that works. We'll use these same numbers, and you'll see on the left-hand side our reimbursement contract paid us $6,000. And we'll say that person didn't pass away after 4 years, but their care progressed and they needed to go to a nursing home. And maybe they wanted to go to a semi-private room in a nursing home that cost about $8,000 a month. Well, in our reimbursement contract, they'll reimburse up to $6,000, right? But there is a $2,000 monthly shortfall. Well, $2,000 shortfall over the year is $24,000, right? So even though they have a maximum of $6,000, our nursing home cost $8,000. We have a shortfall of $2,000 a month over a year in a nursing home. That's $24,000. So we're coming out of pocket $24,000 in this reimbursement contract. On the right-hand side, our indemnity contract offers us $5,000. That's our maximum benefit. So we have a shortfall of $3,000 a month to cover that nursing home cost. Well, that's $36,000 for the year, right? We'd have to come out of pocket $36,000, except for the fact that we got more benefit up front. And so we were able to save in cash some of our benefit. We have $81,000 set aside in our savings account that we were able to pull out of the policy early. That $81,000 is enough to cover our $36,000 shortfall. Not only that, we still have money left over. We've got $40-some thousand left over that we can pass to our heirs. So I hope that example illuminates Nationwide's belief in the value of indemnity, and not only that it gives you a more flexible benefit that doesn't require you to do any sort of care management. You don't have to manage receipts and bills and things like that, but it also gives you the opportunity to get to your benefit earlier, gives you the opportunity to pay for an informal caregiver, and also potentially get your maximum benefit. There are a few other things I want to mention on informal caregiving. First, that there are no special requirements when it comes to a plan of care. So if you filed a long-term care insurance claim before, you know that those claims typically require a plan of care that involves proof of loss. So a plan of care might say, we are going to, or the doctor is going to recommend that the client go to an assisted living facility, and then before we start paying a benefit out of that insurance policy, that insurance company needs to see some proof of loss, a couple of bills that show what that assisted living facility is going to cost, right? Well, with Nationwide, because we pay cash and we don't have restrictions, our plan of care can simply state, and this would require the doctor's recommendation or approval that it is suitable, but that informal care is the plan. It doesn't have to be specific. It doesn't have to state, the grandmother is going to care for at 20% of the time, and then the spouse some of the other percentage of the time, and maybe another family 30% of the time. It doesn't have to be specific. Just the doctor recommends or affirms that informal care is suitable, and that is all we need for approval. I do want to highlight some of the competitors that Nationwide is in the market with, and walk through a net cost comparison. And this is using an example of a 6-year-old female buying a 6-year long-term care policy for a total of $540,000 in total LTC benefits. This is really an apples-to-apples comparison with Nationwide's CareMatters, Lincoln MoneyGuard, and Pacific Life Premier Care. As you see, Nationwide is the only cash indemnity contract, and they all offer simplified underwriting. But for that equivalent benefit of $540,000, Nationwide takes a single premium of $120,179, Lincoln at $117,669, and Pacific Life at $133,738. Now, Nationwide is a bit more than Lincoln MoneyGuard, a few $1,000s more as a single premium. But what this is intended to highlight is net cost to an estate is important to clients. And let me say that for your clients that have liquid assets, maybe they have them sitting in a fixed annuity, maybe they have them in a CD or a bank account, money market that they're accumulating. Their intention, a majority of the time with those liquid assets, is either for an emergency or to pass along, right? This is money that I've been rolling over in CDs. I'm going to pass it down to my grandkids. It's not money that they typically would rely on for any sort of a monthly obligation, right? This is money that they intend to pass along if they don't end up needing it. Now, long-term care is a majority of those emergency expenses that come up for the elderly, right? And so that buying a long-term care policy addresses that first concern. The second concern of passing money down to our heirs is what's highlighted here. So if we're going to move some of our assets that we intend to pass down to our kids into an insurance contract, let's buy one that affects our heirs the least, right? Affects our net cost or bottom line. Well, because Nationwide has this 20% residual death benefit, they're getting some cost recovery. They're getting 20% of their benefit back to them, right? So you'll see at the bottom here, the net cost on that $120,000 is $84,179 because their heirs will get that guaranteed 20% residual death benefit. Whereas Lincoln offers a 5% residual death benefit and Pacific Life a flat $5,000. So when comparing cost, this client may write a check for $120,000, but in reality, it's costing them $84,000 to their estate. So that's something I thought I would highlight. It is helpful in having this conversation with a client. In full disclosure, Lincoln does have a couple of options. This is their 100% vested option. MoneyGuard does also offer an 80% return of premium, which would cost less in premium. So that 117 single premium might cost in the neighborhood of $108,000. That being said, your net cost maybe are a little more equivalent. But for a closer net cost or more equivalent net cost, you can then get the value and the guarantees that indemnity provides. I want to highlight a couple of client scenarios, folks that you can look for that might be a good fit for the product. The first, and this is probably one that you've seen before, but are those folks with sleeping assets or lazy money, as we like to call it, right? Those folks that are 40 to 75, they have CDs that are maturing, maybe bonds, proceeds from selling a business. This next category, 55 to 67, folks closing in on retirement. They're in the peak of their earning capacity. Maybe they're 59 and a half or older. They can access some of their qualified money that's not needed for retirement income. But they could easily pull off 5 annual payments or 10 annual payments out of their income to fund a contract like this. Maybe they are older and they have an IRA that has an RMD. You know, they've met that 70.5 mark and they have to start pooling this income, and you know, maybe they don't really need it, and they're like, hey, I don't want to pay taxes on this. I don't want to have to pull my IRA out. I want to give my IRA to my kids. Well, let's funnel that RMD into a long-term care contract that will cover your long-term care expenses, and then all those assets will be protected so they will go to your kids, right? So that is a great opportunity for long-term care planning. This last category, Henrys, who I'd call high earners, not rich yet, age 40 to 55. This is a category that Nationwide has really seen some success with in appealing to this younger clientele. And I'll tell you, when you look at long-term care insurance and you're talking to a 45-year-old, you know, they're really just planning for retirement and not even beginning to think about being elderly or long-term care planning. And so that can be a hard conversation. But this group of folks is also investment savvy, typically. You know, the younger clients that have gone through a couple of recessions now, they're a little bit more investment savvy and they appreciate some return, especially guaranteed return. And so if you can position a smart investment, that is a lot different than positioning positioning an insurance product, right? And Nationwide has been able to position ourselves that way because we offer a cash indemnity benefit that you can think of as income for your long-term care. You are able to have a different conversation. If you approach this 45-year-old and say, hey, we're going to look at a long-term care linked benefit product that's reimbursement, and they say, okay, well, you know, what are my costs going to be in 30, 40 years? We have no idea, right? If you look at cost projections, depending on where you look and what resources you use, they may be all over the place. It might be $15,000 a month, it might be $30,000 a month, right? And they don't know if their family is going to care for them. They don't know, you know, if they're going to end up in a nursing home, if they prefer assisted living. They're just not there yet, right? And so there's a lot of uncertainty. And because they don't know what their cost is going to be, they don't actually know what they're going to get out of the insurance product. It reimburses your cost, but you don't know what your cost is. But when you can say, let's plan using a cash policy, we're going to reposition some of your income over 10 years, or we're going to take some of these assets that you've accumulated and invest them in a vehicle that not only you can cancel and get your money back, we're going to reposition it as an investment that's going to leverage you for long-term care. And that long-term care, when it kicks in, it pays you guaranteed income. And so you can guarantee them exactly what their return is going to be when they need it. And so that is a different conversation. We found a whole lot of appeal there. This is just a quick example of insurance leverage. I'm sure you've seen similar comparisons before, but it is a good reminder. We'll take a 60-year-old that has a CD, and this CD will assume a rate of 3%. And you and I know that nobody's getting 3% anywhere, but for the sake of this example, we'll use 3%. We'll be generous. $100,000 in this CD at age 88, so 28 years, accumulates about $229,000. And that doesn't include taxes owed on the interest, right? It would take 52 years to get to about $465,000. So this person would be well over 100 years old, right? CareMatters, this insurance policy, we take the $100,000 on this same 60-year-old, we immediately leverage $473,000 of total long-term care. That's available today. It's available at age 88. That LTC benefit, that long-term care benefit, is tax-free, and the residual death benefit of $31,500 in this example is tax-free as well. This is a fantastic leverage story when we're looking at alternative fixed or safe assets. This final graph here, and this is something that we can definitely provide some more information on. We have a couple of white papers that go over it in more detail, but I want to give you this example at a high level, just talk about the opportunity. And I did mention it briefly earlier in the conversation, but it is planning for your wealthy individuals that might have an estate tax consideration. And I call this the cost of being lucky. You see that highlighted here at the bottom. The cost of being lucky is not needing long-term care, right? If you're lucky, you live to old age, you're perfectly healthy, maybe you pass away in your sleep and you never have that situation of needing care. So that's lucky. Well, for a wealthy individual maybe that has 10 million more of assets and has that estate tax burden, what is that cost? Well, as a financial planner, if you're putting money aside for that individual to use for their health care costs and their long-term care costs, you might have set aside $1 million, right? That's not already put into some sort of trust. That $1 million taxed at the estate tax rate of 40%, the federal tax rate of 40%, is $400,000. And that does not include any state that might have state estate taxes, right? But at the federal tax rate of 40%, we have $400,000 in estate taxes on that $1 million. Well, if we're already earmarking that money for the government, why not be a little smarter with our money and do some tax planning? Why not take a portion of that $400,000 and put the CareMatters contract inside of an islet? So we'll remove whatever assets we put inside the islet, put it inside of this long-term care product that gives us maybe 5, 6 times leverage in total LTC benefit. And what's fantastic about this is because it is an indemnity product, we're going to make cash payments to the trust. And as we're making cash payments to the trust, that trust is growing with tax-free benefits that will pass to the beneficiaries. That client could choose to, if they have a long-term care need, to pay for the long-term care out of pocket. So they're reducing their liquid assets by paying for it out of pocket, all the while their trust is growing in size. And so they're really doing some fantastic tax arbitrage. If they do pass away and don't need the long-term care, then the trust still gets that tax-free death benefit. And so it is still fantastic tax planning. For a client that may put all of their liquid assets in some sort of non-cash option, and they don't have liquid assets and they need to access some of this benefit, they certainly can. There are ways to design the trust, to loan against the trust to get some of that long-term care benefit out, to pay for our long-term care needs, that also would allow for this to work. So I hope that gives you some insight into some of the more unique things that you can do with the product. Beyond just tax planning for the wealthy individuals, you can also use this product for some unique business planning, whether it's a buy-sell scenario for 2 business partners, because it is a cash benefit and it's not a reimbursement for the insurance cost. We can pay business partners a long-term care benefit and protect their business if one of the partners needs care. So there are a couple of other unique scenarios that we can offer with this product. At this time, I would like to go ahead and open it up for any questions. Jason, if there are questions that have come up, if they've been typed in, I'd be happy to address those or open up the lines.
John, at this point, I don't have any questions that have been asked.
Okay. Fantastic. Well, I really appreciate your time and allowing me to come on and present. I hope this information was helpful. Please reach out to Jason at URL if there's any additional information. I'd be happy to provide more on that wealthy individual planning or any questions that come up about Nationwide's product. Thank you all for your time.
John, thanks a lot for the great and informative presentation. Like John said, if there's any questions that anybody has in the future, please feel free to reach out to myself, Maria Adams, or Joe Corio. I'd like to thank everybody for joining the presentation today. Please feel free to give us a call at URL for all your single premium life needs and annuity. Should it be brochures, illustrations, or, like we talked about, just simply questions to, or answers to your questions. Our toll-free number here is 1-800-926-8875. Again, my name is Jason Collins. I'm at extension 156. Joe Corio is at extension 111, and Maria Adams is at extension 102. Thanks, everybody. Have a wonderful day.